We appreciate you jumping on tonight, right? Mark Beckett, my partner in crime here. We've been running this for some time. Our intent is to give you the information, the access, the tools in order to help you build your real estate investment business, whatever that looks like, right? We want it to be as big, as bad as you can possibly dream it to be. And in order to do that, you're going to need access to capital. And tonight, it's all about getting access to capital. And we want to open your mind as to different sources for accessing that capital. This is a collaborative environment, although we don't have everybody on here to be able to participate. Just put your questions in the chat and we'll make sure that we answer those questions, right? And we love doing this. This is why we do it. We partner with lots of people on here to do deals, to raise capital, and really just to talk shop, right? This is what we love to do. So even though I'm on vacation right now, I'm here doing this. I was out looking at real estate today because that's what I dream about most of the time. And it's my hobby, right? I love doing it. So I'm in Cumberland. I'm in Cumberland, Maryland, visiting my parents, right? Mm-hmm. I was riding my bike earlier today in the canal. And this is, they live in a 7,000 square foot, you can't see this, but they live in a 7,000 square foot commercial building. And you see the big building outside?
Yeah.
Yeah. So I'm on the second level. This is her paint studio, my mom's paint studio. And she's got the gallery downstairs. And they bought this property years ago when I was buying a lot of real estate here in Cumberland. So just full circle, right? Kim and I were buying about 20 houses a year, fixing and flipping them and keeping some of them. And, so here we are talking about money, right? So Bex, tell me about you. Tell everybody here about you.
Yeah. So Mark Beckett, for those that I don't already know, as Rob said, we've been running this for a little over 10 years or so now. I've met Rob in this space, not on this virtual space, but at this meeting, right? 10 some odd years ago. It's been 10 years of fun ever since. So my focus is mainly on our investing in construction side. I run CAZA Construction that does a lot of the pre-sale renovation work for our listing clients at CAZA Group. And every so often when we find a good deal, we'll buy a deal. And we do rehabs, a little bit of rental properties. I think we had a leak in one of the rentals from the rain yesterday. So that was on the agenda for today. Landlord fund that we talked a lot about, I think a little bit last month. And yeah, landlording, rehabbing, building.
Yeah, we had
kind of what we do.
I think a lot of people flooded, right? This over the last couple of days, right? We had this one property that we're putting on the market in Colorado that got some water into it, $6 million. I believe you're going to be going out there to help.
I'm going to that property tomorrow. Yep, to find out what's going on with that. So, yep, we got to be flexible, right?
That's right. So if anybody's looking for a $6 million
flip
quasi fixer upper in Colorado, let us know. It's coming on the market in the next week and a half, 2 weeks.
Right? Yeah, I think let's get started and into it. Could I ask Rob, could you make me the host? And Mark, I'll share my screen just to be able to go live on Facebook. If you can do that real quick. Thank you.
So, Rob, you got to do that because what's happening is I'm breaking it. I keep sharing my screen so I can control the slides, but Ali is controlling broadcast. So. Okay,
so wait a second. So what do I need to do here is you have to make him the host, right? I believe you have to make
Rob, you'll make me the host, and Mark, I can take care of the slides.
Right.
But I don't think I have because I'm on as a panelist. How can I make you the host here?
You are the host.
Right? Oh, no, I see it. I think I see it.
Sorry about that.
Okay. Let me see. Ali. You guys are making me work now, guys. Mark, you sure you can't make him the host because it looks like both you and I are on here? It says that he's the co-host. I could already see Ali's the co-host.
Yep, co-host. I agree.
All right, if you have an option to make me the host, I'll be able to go live. Otherwise, we can just continue.
Sorry, guys. Hang on one second. Let's. Here we go. Ali, I think I did it.
Cool. Thank you.
There we go. Okay. Sorry, guys.
We think we did it.
Okay. Cool. Let's do it. We got 17 people, 20 people, 25 people. Let's go.
We got Sloan Wiesen out there giving us a hard time about not wearing masks. So thank you, Sloan.
What do you mean? There's nobody here.
Feel free, by the way, everyone, to introduce yourself in the chat box. So just kind of wiggle your mouse, go down to the bottom of your screen, click on chat. That'll bring up the chat box and say hello, say what's up. Feel free to post your contact information. In fact, I'll get us started.
Cool.
And post mine. And if you've got deals, post up your deal. If you've got questions, obviously, post your questions, comments about what we're saying. This is meant to be an interactive discussion. We are not professional teachers. We just tell you what we do, right? And we'll tell you what we do and how we do it and what we understand about the topic, and hope to engage in as much discussion as we can, because it's always better that way, right?
So you're click and I'm clack, or am I clack and you're click?
I guess.
Okay. Well, let's do this. This is a topic, right? This is a topic that I love talking about, because when I first started in the business, Mark, you know, one of the misconceptions that a lot of real estate agents have and new investors have is they think they need the money before they get started. They might say something along the lines of, I can't get started because I don't have the money, right? And as we kind of teach everybody, and everybody, you know, learns, is that really the money follows you if you have the deal, right? So if you have the deal, the money kind of will present itself, but you still have to know where to access this money, right? So tonight's topic is all about the different areas where you can access money. And guys, you know, you don't need to have the cash yourself. You just need to have the knowledge, right? You need to have the deal and you need to have the knowledge. So tonight we want to, you know, break some of those myths that are out there. And we want to chat with you about how, you know, through stories of how we did some of our, you know, deals. So you can get an idea of how we raised capital or found some, you know, money when we were, you know, hard pressed to find money and doing deals. And I'll share with you, you know, some creative things that I've done, and Mark will share with you some creative things that he's done. And then we'll just facilitate it that way. Right. So,
next slide.
Next slide. Let's do it, Ali. And I believe, right, we already kind of went through, we made some intros and people are already introducing themselves, right? But Mark, yeah, the legal stuff. You always say the legal stuff is, hey, do your own due diligence, right? Yep. What we're telling you here is what works for us, but your mileage is going to vary considerably. You know, could be better, could be worse. But, you know, we're here just sharing with you guys the information, knowledge that we've learned along the way, and take it, you know, for what it's worth. Do your own due diligence on it.
Correct.
Right.
All right. So the point of this discussion then is to talk about how to fund a deal. So we're already going to assume that you found what you believe to be a good deal, right?
Hallelujah. You found a deal in this incredibly difficult market. Oh, by the way, we should probably talk about that real fast, right?
Yeah.
It's crazy right now out there.
Price is still going up. We're seeing appreciation across the board in Northern Virginia.
Yeah. I mean, the inventory levels, crazy low. Yeah. Competition on those properties, incredibly intense.
Multiple
right?
offers on anything that's publicly listed that's even remotely close to appropriately priced.
Yeah, if it's appropriately priced and it looks good, I mean, like we're talking multiple offers. Yep. So it's like a tsunami for sellers right now. It's like the perfect storm, right, for sellers. Yep. So, yeah, it's a little crazy, right, for sure.
So you've got to go off market for a lot of stuff, although you can occasionally still find, I think, some workable deals. I see people buying things on market and still having them work as rehabs, but they're predominantly self-contracting, right? It's tough to do if you've got to hire a contractor and pay them a fee at what you have to pay for open market prices. So most of it's off market. We know some people who are wholesaling, a lot of people who are wholesaling. So if you're looking for deals, try to find every wholesaler you can, get on their list, find deals that way, market for deals, network for deals. We do this because it grows our network. We think networking is one of the best ways to find opportunities. The things that I'm looking at now are all coming to me through the network, right? Just through people I know. They know we're always looking. I will pay you for a lead on a deal. I will partner with you on a deal. I'll bring the money if you found it. It's all about being flexible, right? And putting it out
for
there.
sure. I
So
mean,
how did you hear about the deal that you're looking at, by the way?
Through the network,
Right.
right? So, you know, I happened to mention to Lee that I was looking for something for my parents, and she sent me some options that I was looking in like the Harper's Ferry area, and she said, well, what about kind of like the canoe capital, you know, of Virginia, and looking the Front Royal area, and she sent me some options, and one of the first options there was this property in a coming soon status, right? And because this is what I love to do, I just drove out there, went to go check out the land, see if the land even makes sense, right?
Yep.
And I fell in love with the land. I called the agent. I said, I know you're in coming soon status, but can I just walk the lot, right? They let me walk the lot, fell in love with the lot. The house is tiny, so it's not much to the house. It's really the lot. And so I have an offer in on the property. So it came through the network, right?
And what would you do on it? You're going to build on it?
What I want to be able to do is I want to add to what's there, create possibly a little Airbnb or possibly a place for my family and I to retreat to, right? And which you're finding a lot of people doing right now, having a nice, quiet place in the woods to retreat to, and maybe even build another small unit on the property that we could rent out if we wanted to, or have other friends or family stay in and make it private in the woods, right, overlooking the Shenandoah River. Would be awesome. Okay. So, hopefully I hear back tonight and that I've won that contract, and let's see.
Very interesting. All right, well, let's move to the next slide, talk about some sources of money. And then when we get to the one that you're using to buy this house, stop me.
Okay.
And we'll see which method you're using to acquire your projects. So cool. There are a few ways to fund your rehab deal, rental deal, whatever your real estate acquisition is. Obviously, the one that's the easiest, everybody kind of understands, is cash. You got cash, you can buy your house. Rob, you've bought houses for cash, right?
Yes.
Where do you buy houses for cash? You're a billionaire, I guess. You can buy a house anywhere for cash. But where'd you buy your first house? Mr. Beckett. Where'd you buy your first all cash house?
Cumberland, Maryland.
What'd you pay for it?
Oh, dude, it's so crazy. I drove by it today. $8,000.
$8,000 for a house with a roof.
$8,000.
What year was that?
That was 15 years ago, right? Probably. Yeah, 15 or so. That was one of the houses that we bought lots of houses cash. I mean, there are places, by the way, in the Midwest, there's places like, where I am in Cumberland, Maryland right now, where you can buy a piece of property for $10,000, $15,000, $20,000, $30,000, $40,000 cash. I'm not saying it's a good investment, by the way. I'm not saying that. Some of them can be good. But those markets still exist today, right? And that's where I cut my teeth when it really came to doing volume. And I learned the volume game in this market, which is where I'm at right now, right? So those, my parents have this 7,000 square foot commercial building. I don't know if you could, Mark, can you see outside the window?
Yeah.
Yeah, this is so we're in the downtown historic area. And, every time I drive through here, I see opportunity everywhere.
All right. So we bought houses for cash in Northeast and Southeast DC.
Yep.
I don't know if you remember, Rob, we had one on like Southern Avenue like 10 something years ago. I think we bought it for like $40,000, a row house. I think we put like $40,000 into it because it was a disaster. So we're into it for 80. And
I think we sold for like $150.
150. Yeah. We buy them for 50, put 40 into them and sell them for 150. So in the last 10 years in the DC area, you could buy houses for cash. I think those same houses now are like 150 in the condition that we were buying them in. So they sell now for probably 2 to 250. So there's not quite as much margin there, and it takes a lot more cash to do it. But there are still in some pockets inside the Beltway, even properties you can buy for under 50 grand. Well, maybe not under 50, maybe under 100 that are still technically single families that aren't condos that might make sense to rehab. So if you have that kind of cash, you can buy those houses for cash. Question is, though, even if you have $150,000 to buy a downtown row house rehab, or even $250,000 to buy a Herndon townhouse rehab, or $500,000 to buy a nice Reston single family that might need renovation, is it the best use of your capital?
Typically not.
Typically not, right?
Yeah.
I know I don't sleep well at night when 100% of my investable capital is deployed in something as really honestly risky as real estate, right? This isn't like, putting it all in the stock market. Hopefully markets go up or down, but real estate is a cyclical market. Stuff happens. You can get surprises in houses, and it's just not a fun feeling to be 100% invested and you're not sure where your rent money is coming from next month because all your money is invested in a deal. So it's not a great way to live. I don't think it's a great way to sleep at night, to have all of your money invested in cash, nor is it necessarily the best way to get a good return on your money. We'll talk a little bit more about leverage in a minute, but the reason you want to use someone else's money is because the money that you make using someone else's money almost always has a higher rate of return than you're going to get on your own, right? So yeah. I think most people get that. Most people understand that you borrow for a couple of reasons. One, because it gives you liquidity that you might not otherwise have. You just don't have the cash. Or even if you do, the return is better on properly used leverage. And if I've got that 100,000 and I only need 50 to buy a house, maybe I can buy 2, right? With my 100 instead of put it all into one.
Yeah, what we've seen over the last what we've seen here now for some time is, though, people that have a lot of cash buying at the auction or buying these properties cash, and because it is their cash, they can offer more because they're not paying the interest or the points associated with that. So they're a little bit more competitive, right, in a market like we're in right now. And so, cash ultimately is king. But if you don't have it, guys, don't worry about it. We're going to show you other sources that you can draw upon or partner with, right, in order to, do some of these deals, right?
Yep.
You've got on here home equity, right?
Yep. You ever use your home equity to buy a property?
Yeah, multiple times, right?
How's that work?
How is that working, or how did that work?
How does that process work?
Well, you get an equity line, right, against your typically your primary mortgage. You could do it against an investment, but it's a little bit more difficult, but it's totally an investment that's completely paid off. Wells Fargo, I know, will typically give you at least 50 LTV, where you can get a line against that asset, by the way. And so you can't have an equity line against an investment like that. But it's easiest to do against your primary residence. You go down to, I went to Summit Bank, which is in Leesburg. And Summit Bank, they sent out an appraiser. They said, hey, this is how much you owe. This is how much we're willing to give you in terms of an equity line against the house. And then think of it as a way to be able to access capital quickly if needed for a deal. So I signed some paperwork. I don't pay any money at all while that just sits there, right? It's only when the money is deployed do I start paying interest on that money. And, it's the way to access cash that's kind of stuck in your property, right? We have a good friend of ours that literally has equity lines against all of his assets. I mean, he's got a ton of cash, right? But he has equity line against all of his assets because he knows that he's paying, 3 or 4% on that equity line, but he's lending it out at 10 to 12%, right, on the back end. And so he's creating the arbitrage on something that he has, right? And so equity lines are a great source, right?
And right now, rates are as low as they're going to get, right?
Yeah, they're low, man.
It is a great time to be borrowing if you need to borrow from traditional institutions because the rates are as low as they're ever going to get. So home equity, there's really no advantage to big bank, small bank, local bank, national bank. It's whoever's got a good rate and is willing to give you the most money, the highest loan to value. But they're all pretty much the same. Big banks, small banks, they're all lending at 75 to 85% LTV on a home equity line on your personal residence, less on an investment property. But you just have to call a couple of them and you'd find one that was willing to
do some due diligence. Yeah, the other one is you've got on here other investments. One that we have is a whole life policy, right? So I've been funding this whole life policy now for, 5-6 years. And there's $60,000 in cash value in that I could access at any point for real estate, right? For anything that I want. And I still have the benefit of life insurance tied to it. So that's another source that a lot of people sometimes overlook. They don't talk a lot about. There's a great book called What Would the Rockefellers Do? And in there, they talk about that. How do you create a family bank using whole life insurance to be able to make that happen. So I recommend the book, right? What Would the Rockefellers Do? And I have access to that capital. It's my money, right? That I've been kind of putting away. And I could use it, to buy this particular piece of property.
Yeah.
Yep. Okay. Mark put it on there. What would the Rockefellers do? So
there you go. Nice.
Great little book.
All right. So if you're a Rockefeller and you have other investments, you can also sell them to generate the cash to buy your real estate. Not something we are recommending you do. If you've got other investments that are working for you, diversification is always good. Back to my first point, I wouldn't put every last penny I have into real estate, and I wouldn't recommend that you sell out of your nicely performing IRA
the number
fund.
one regret, Mark, that I hear every investor say is like, I wish I hadn't sold that property. I wish I had kept more of the properties that I own. Because they wake up 15, 20 years ago and they start going, I remember when I owned that for $200,000 and now it's $600,000, right? So if you could find a way to find the money without liquidating, I think, a good asset in a growing area, like that, don't sell those assets, right? If the area is a growing area, don't sell them, right? Find a way to find the money some other way, right?
And that
I had a conversation with a friend last night. He said that same thing. He sold his primary to buy another one. Yeah. And he said, I wish I had just done a cash out refi because the interest rates are so low, right? That I would have been able to pay exactly what I'm paying right now, make $100 on the rental rate, right? For renting that property off. And I still would have been able to buy my next house, right? Yeah. And so figure it out. Selling is the easy way typically.
Right.
Lazy way.
Right. So the next one then is individual retirement accounts. A lot of people have retirement accounts from old jobs or self-funded or wherever the money comes from. It's in your IRA, right? And most people know what IRAs are for. And I think most people assume that how you use them is you invest in a basket of stocks or mutual funds or government bonds or whatever it's going to be. And the most exotic thing that people do with it is buy options or things with it in the stock market and keep most of their retirement funds in some form of stocks. But did you know that you can use your retirement funds to buy real estate, right?
Yep.
How do you do that?
So there are third-party intermediaries. I always have a hard time saying that word. like equity trust is one of them. There's a bunch of them out there. Equity trust is like the 800-pound gorilla. And they allow you to be able to invest in hard assets like gold and silver and real estate or notes, right? So through my self-directed IRA, I've lent money out and created personal notes. I've purchased, I own a little house in my self-directed IRA that gives me a 16% cash on cash return on that little property, right? It's been a great little asset. You know, the self-directed IRA is a really, really powerful tool that you should look into if you haven't looked into it. At the time, what I did was I had a simple IRA with a previous business, and I just rolled it into the self-directed IRA, right? And you could have a Roth self-directed IRA, or you can have a, solo 401k. There's lots of different options, right? I don't claim to be an expert at it. I just know that with my self-directed IRA, I've been able to invest that money to buy real estate or to lend on, and it's been great, right? And by the way, you can partner. There's restrictions to it, right? So I can't go and buy a personal piece of property, that I'm going to somehow move into, right, or anything like that, or a building that I'm going to occupy for my business using my self-directed IRA. But Mark, I can lend you the money for my self-directed IRA, right? Yep. If I own, I think it's under 50%, and you own, so if you own 51%, I own 49%, and I want to go buy a building for the business, I could do that with my self-directed IRA because you're the majority owner of that,
right,
of that asset, right?
Yep.
But anything above 50%, I can't. And so there are rules. I can't lend it to mom and dad, right?
Right.
There are rules and restrictions around that. So you just have to read up on that. But it is a powerful wealth building tool. Very powerful wealth building tool.
And you don't have to have 100% of the funds available in the IRA. You can start with any amount of money in a self-directed IRA, put that money towards your investment along with the equity that you get from cash or a partner or a loan,
sure,
wherever it's coming from. And you can use it to fund that IRA and put back into it just about however much of your profit you want to direct back to that IRA. So they are a great way to access money that a lot of people have sitting around in stocks and mutual funds and things that are a lot less rate of return than real estate sometimes. So Christina actually is asking referrals for a self-directed IRA. Equity trust are the one that Rob and I both use. I've used Millennium Trust, but equity specializes in real estate, or at least they know a lot about investing in real estate. So they are one of the easiest to work with to invest in.
Yeah, and like anything, right? You're going to have people that don't like equity trust, but they like some other one. There's some other ones. There's some investors that don't like equity trust because there are some hoops that you have to jump through to be able to get the money to be able to fund the investment. And there are some other ones out there that essentially give you like a checkbook, right? And you are the controller of the money. And to me, that always seems dangerous because there's rules around your self-directed IRA to make sure so I wanted to make sure that I was dotting every I and crossing every T. And you don't want it to be as easy as just writing a check, because I think that's when people get in trouble, right? When there is a third party and there's some rules around it, it gives you pause. You ask yourself the question, is this really what I want to do, right? It makes you think through the investment a little bit more. So I like that. I appreciate that. And they're the 800-pound gorilla in the industry. So they've funded a lot of deals. So that they've gone through, stress tests already.
Right.
So that's why I use them.
And as far as an actual contact, Christina, just go on their website. And I think, Rob, we actually have upcoming a topic focused on alternative investments, and we'll maybe get into it more about self-directed in particular, and anyone else out there who does it.
We should have some kind of affiliate program with Equity Trust, man. The amount of times I
probably should
to them. Yeah, we should.
You're probably right. All right. We'll set that up for
We'll
next
set that up.
And Sloan was asking about the percentage that you can use. Can you use up to 50%, borrow up to 50%? You can, in most cases, have the self-directed IRA participate at any level you want. It can fund 100% of your investment. It can fund 1% of your investment. You can use all of the funds in your IRA at once. You can use only 10% of the funds in your IRA at once. It's very flexible that way, as long as you're operating within the other rules. Like Rob said, you can't self-deal and lend directly to yourself, but you can lend to an entity that you're affiliated with or an entity that's buying a house. There are rules with how you can use the money as far as where it goes, but the amounts are really flexible. You can lend $1, that can be all you have in the account, or you can lend just $1 out of the account. They're highly flexible that way.
Yeah.
All right, so that's it on the kind of cheap and easy money. Now let's talk about other sources that are either more exotic, more expensive, more flexible, or just different than cash. Friends, family, and partners. So we've all done this, right? I've got the deal, you've got the money. Let's figure it out. Let's split this thing up. You give me the money. I've found this cool deal, and we'll split what comes out of it. We've actually done 3-way splits, 4-way splits. We've had several partners each put in different amounts of capital.
I mean, I remember, 10 years ago, we were like, okay, Mark, you manage the project, you get a third. Rob finds and helps sell the project, I get a third. And, then there's a guy that's got cash and Rich funds it all, and he gets a third. And we just did it that way, right? We created an entity and kind of split up the task that way.
Yep.
But it is expensive doing it that way.
Yep. And you can use friends, family, other people, people that you meet at investor groups. Vet them, right? We're not recommending you do that, but if you meet people at investor networking events, you can partner with them if they have money and you have the deal, or vice versa. But just realize that it can be expensive to you as the deal maker, because the hardest thing to find is the deal. And the easiest thing just about to find is somebody out there with money that's looking to make good money on their money, and giving up half of the profit in exchange for some or all of the funding may or may not be the best deal for you as the investor or person with the project. If you've got a partnership and a business and you have other things going on, then that makes sense. Or if you have a rich uncle who's going to lend you money at 5%, then that makes a lot of sense. But before you just go out and say, hey, I've got this really good deal, who wants to help me with a deal, and give away half of it, consider possible other alternatives for getting your money, because you don't necessarily have to give up large percentages or most of your deal just to get it funded, right? That's one reason not to do it, because it costs you sometimes a lot of the profit just to bring in a partner. And the other part is, now you've got a partner.
Now you got to deal with a partner.
You got to deal with a partner, and people have different opinions on how to manage projects, even if they don't say they're going to at the beginning. Once somebody's 50 grand or 150 grand or 500 grand is in your project, surprise, surprise, they show up and have an opinion about, why are you doing it this way? Why does it look like that? I think we ought to be asking this much. And all of a sudden, your silent partner becomes a lot less silent once their money is invested in a thing. And that adds a whole nother layer.
Yeah, and you have to know yourself when it comes to that. Like, I love working with partners. I think you love working with partners. Like, we're reasonable people, like we can work these things out. But there's some people that just do not play nice with other people, right? And they get stressed out. They lose their mind about things. And so you got to be careful that you don't go into a partnership with somebody like that. Vet them up early, right? Test them. You make sure that you enter in with an operating agreement that defines everything that could go wrong, right? And talk about that on the front end.
Yep.
So that it is essentially, if we get divorced, what happens, right? Okay, we have the prenup here that defines how this is gonna go down. So as long as that's defined on the front end, typically it works out well, right? Yep. But you got to pay attention to who you're going into partnership with. But I got something fun or irresponsible to talk about, right?
Yeah.
What's the the most irresponsible place you've drawn money against to do some kind of investment? Have you done anything like that? Have you done any like crazy thing?
The most
To raise capital?
irresponsible place?
Like just crazy way to raise money.
But
Or silly way.
not that I can think of. Out of my own bank account is the craziest thing I do with it. I'm assuming that you've gotten money from somewhere else. Where have you gotten money?
The Cayman Islands. Let me tell you the story about what happened. No, I'm joking. No, I remember this was back early on. I didn't have any cash. I was like, no cash. I wanted to buy something. And I had this car paid for free and clear. And somehow I refinanced my car, right? This was like 20 years ago. And it gave me like $8,000 or $9,000, which was enough for me to be able to complete this deal. I still own that house today. So like I literally, refinanced and got a loan against my car.
Would that have been a title loan?
Well, it was USAA, and USAA, right, said, hey, you can refinance your car. And I'm like,
got it. Okay.
Yeah.
So USAA is a legitimate lender. You paid regular market rates for that, 5, 6, 7, whatever the rates were at the time, and not a title loan that you could get on the corner next to the check cashing guy at like 55% annual interest rate. So do not, if people go out there and get title loans on your car to invest in real estate, that is bad.
Well, I'm sorry. Now that I tell that story, now I have a friend of mine, an acquaintance. I haven't talked to him in a while. He owned a bunch of pawn shops, right? And I learned, pawn shop is just a big lending institution, right? That's what it is. They're lenders, right? That's what that business is. And I guarantee you, people have probably pawned things to be able to buy real estate, right? So anyhow, just a funny aside. If you can generate the cash, look at the things around you to be able to generate cash, right? My wife right now is in St. Louis helping her mom, sell her family home because her mom's elderly and, in a home now. And Kim's having so much fun putting everything on Facebook Marketplace and just converting all these old things to cash, right?
Right.
So cash is kind of like all around you, right?
I'm going to give her a bunch of boxes of old G.I. Joes to sell for me down in the basement.
Cool. She'd love it. Love it.
Probably worth more invested in real estate. All right. So, and I agree with you. I like partnering with people too. Just realize what it costs you. Go into it with a complete agreement and understanding of how the partnership is going to work, and what you do when there is a disagreement, and just know what you're getting into with your partnership. Then the last source of funding that we're going to talk about is then loans, borrowed money. I think everyone kind of understands that when you borrow money, it usually has a cost. You pay interest, right, to the person that you borrowed money from. So it inherently is always going to cost more than cash, because you're going to pay someone else for the privilege of using their money. But that doesn't necessarily mean that it doesn't possibly make you more in the end, which we'll come back to. We touched on a little bit. Loans, though, are oftentimes the only way to do it. Like you said, Rob, if you don't have the cash, you're going to have to borrow it from somewhere. But not only might you have to do it, you might want to do it because they are the best combination of quick funding, the amount of leverage that you need, the cost versus those other options, plus the ability to, when you've got a good lender, get the money exactly when you need it for a deal.
So Ruben posted something on here and said, hey, according to Robert Kiyosaki, he used credit cards, which, by the way, I had done as well, to fund some of his deals early on.
I have. I've definitely done that.
Yeah.
Yep.
And you're right. It's much more difficult to do now, Ruben, in 2020, for sure. Right.
Well, I mean, you say that, but I'm probably sitting on a half a dozen checks from the credit card companies that I could write to borrow against at, I think it's 4% for a year. After a year, though, it goes up. It's free financing for a year. It's a 4% funding fee. So if you pay it back in a year, it costs you 4%. If you hold it more than 1 day after that 1 year, it goes to your whatever it is, 16, 17, 18% credit card rate. That might still work if you're making 50%, 60%, 80%, 100% on your money. There are deals that, had I known, I would have just liquidated every or leveraged every credit card to have bought the deal at 20%. 20% annual interest is not great, but it's not bad if you're making 21, right? So credit cards can be a fine source of capital as long as what you're making exceeds the rate that you're paying. And if you can get that money paid back in a year, there are plenty of credit cards that will give you 1 year at 3 and 4%, hoping that you go past a year and then go at the higher rate. But I've done that. I've borrowed and paid them off inside the year and borrowed money at 4%. It's great.
Yeah. There you go.
Nothing wrong with that at all. But that's not really what I'd call a loan. That's borrowing against a credit line that you've already got. Loans come from lenders, right? And so what kind of lenders are there? Traditional banks are the ones that everybody already knows about. And we have plenty of traditional bank loans, right? We've got Wells Fargo loans and TD Bank loans and Bank of America loans.
Right, SunTrust. Yeah.
SunTrust is a good lender for rental property real estate. We talked about this last month with the discussion on rentals, but if you're buying a project or buying a property to rent out, small local banks are a great place to get your loan.
Great place. Awesome.
That's what you want. You want that good 30-year money that has the lowest possible interest rate, the lowest possible monthly mortgage amount. You rent it out for more than that, you're making the spread. That's how you build wealth. And traditional banks also can theoretically work for your rehab loan, but if it's your first time, your first deal, even your first couple of deals, you're probably going to have a harder time getting a Bank of America, for instance, to loan you all of the money you're going to need to buy your beat up rehab.
I just bought a house. Did
you get it?
I got it.
Look at that. Live.
Look at that.
Live in real time, doing deals.
On the Shenandoah. Love it.
Well, cool. Is that where they said they just found, I guess, uranium leaks into the local creek?
Good, because I can refine that and make a lot more money.
All right, yeah, good. Yeah, uranium.
Sell it to, what is it? I'm Back to the Future. Sell it to the anyhow.
The bad guys. Yeah. How are you going to fund this thing? You going to go to a bank?
Dude, I'm going to you, Daddy Warbucks.
Okay.
Mark Beckett.
Well, that's a private loan. We'll talk about that in a second.
Okay.
But traditional banks, have you ever borrowed from a traditional bank to do a rehab?
No, not to do a rehab.
I have not. I've asked, but what you find most of the time when you ask your regular traditional lender if they'll fund my renovation project, they'll say, sure, we'll look at that. Send us your contract. Let's take a look at it. We have to appraise it and underwrite it, but it seems like it's maybe a good deal. Give us a couple of weeks to look at it and a couple of weeks to underwrite it, and we could probably loan you like 70%. It'll take you 3+ weeks to get an answer, just like it does on the house that you're living in to buy. And usually by then, your deal is gone, right? For us to make money on it, we're usually buying these deals that need a lot of love. The sellers are motivated, and we're telling them we can close in cash in a couple of weeks, 10 days, 7 days, 5 days. We're going to close quickly. We're going to solve your problem, take this weight off your back, and allow you to move on with your life. That's our pitch. And in order to do that, we got to be quick, right? We got to be fast. Yeah.
Especially, Mark, in the environment that we're in right now, right? The market's moving so quickly that if you were to approach somebody with a 203K loan, would be a traditional bank renovation loan, right? They would be like, no way, I'm not going to put myself through that aggravation, because there's going to be somebody that has cash, or they're going to come with 25% down or 20% down and be able to take this project out quickly, right?
Yep.
And so, but a 203K loan works awesome in a more balanced market. right? Just this market right now is not great.
Or in a situation where you have the line on a deal and there's no competition and the seller's okay with it, you've got 4 weeks to close, you've got time to go and get your funding. If that's the situation that you're in, then great. A traditional bank loan is usually going to be the least expensive with the best terms that you're going to get from a lender. Just know that they're probably going to want 25% down. They'll take a few weeks to close it. And if you don't have experience doing it, they might not like the idea of lending you 75% against a house with a hole in the roof and a flooded out basement to try to fix it up and renovate. That's not the business they're in. Most importantly, because they're afraid that you're going to do this deal in 6 months and pay them their money back. They don't make money lending you, loans at 4% and you pay them off in 6 months or less. It costs them more in managing that process back and forth than they make on it. They don't want to do that. They're not designed to do that. They won't willingly do that. You can get traditional funding from a traditional lender after you've developed a history and some track record of experience, but then it's really not even a traditional one loan for one property. You usually eventually end up with what's called a commercial line of credit, where you say, all right, I do this as a business. This is my business. I did 4 of them last year. I made 150 grand rehabbing houses. I've paid back all of my loans. I know what I'm doing. Will you lend money to my business? My business is buying houses. You can get approved for commercial lines of credit for that with some experience and with a couple $100 grand to stick in their bank that they can feel good about taking on your new account. Those you can get. It is infinitely harder, though, just to walk into a SunTrust and get a 30-year loan for your rehab deal when everybody knows you're intending to pay it back in 6 months. And you can say that you're going to buy it for your personal residence and just happen to renovate it and sell it. Just don't let them find out about it, that was your intent, because that is fraud. So
that is fraud. We do not advocate that at all.
We do not tell you to lie to your bank about what you're going to do. So that's the deal with traditional banks. Ruben says he got a 203K for a duplex in DC and got it closed in 4 weeks. That's about right.
That's awesome. That's great. That's great. That's fast for 203K loan.
Yep.
They knew what they were doing.
We're seeing it, right? We're seeing lenders getting things closed within a month. 203K actually requires usually a couple of estimates from contractors. You've got to have a good scope of work. You have to be able to prove going in that you know what you're doing, that it is a good loan. All things you should be doing anyway. You
got to get an appraisal of what the after repair value is going to be like. I mean, it could be hard.
Yeah. Yep. But doable, right? And if you've got 4 weeks to close the deal, highly recommend it. If you can get traditional lending from a traditional bank, that is the cheapest money you're going to get. All right. So next slide. Then it talks about other loans. So if you are not getting your traditional loan and you're not going to pull money out of the mattress, where do you get your money? Enter private money or hard money lending, right? Don't want to get too far off the rails with what hard money means. It's an old banker's term that the money is backed by the assets and not like the good faith and credit of the borrower. Hard money is just an old term for money borrowed from a individual or small company for the purpose of investing in some kind of commercial enterprise with a short term that you intend to pay back relatively quickly. Hard is a misnomer as far as how hard it is to get and use. Not hard to find, not hard to get, and not hard to use. So don't think of hard money as something that's hard to do or hard to pay back or hard to make work. That's just an old-timey banking name for private lending. I like to just call it private.
I thought they called it hard money because if you didn't pay it back,
it's hard on you.
It's hard on you, man. They come back and break your legs.
It's always hard to live when you're not paying your loans back, right? You don't pay the loan back on your personal house. What happens? You don't get to keep it. It becomes a hard situation. But yeah, it really is not a great name. Private lending is as good a name as anything for it because the way to think about it is it's typically coming from private individuals or small groups of individuals, not guys in a brick and mortar bank down on the corner somewhere. These are usually individuals or smaller groups of people who have access to reasonable.
Yeah, the people on here, we can get together, each toss in, you know, $10,000, $15,000.
That's right.
Get a little private fund.
That's right. We are hard money lenders. We are private lenders. We have some cash. We know other people with cash. We sometimes put it together and lend it to people. So I prefer to call it private lending, but the name that you'll hear most often is hard money lending, hard money lender, hard money loan. And all it is a loan that is meant for a short-term commercial purpose, like a fix and flip property. We'll get into the terms, but it's not like a traditional bank in their speed, ability to react, ability to understand what it is that you're doing. A hard money lender or private lender that knows what they're doing will already have done rehabs themselves. They'll know what your project is supposed to look like. They'll know what the numbers are supposed to look like. They'll be good at running the numbers and determining the after repair value to know if you're actually looking at a good deal. We'll talk about that in a second. It is different than just walking into a traditional bank and saying, here's the property I want to buy. Give me, let me know in a couple of weeks if you want to loan me a couple of bucks. So the biggest difference, though, is that flexibility, is the understanding of what this business is in fix and flip and fix and rent property, and being able to fund those deals in an hour, right? A good hard money lender can give you a commitment same day. Show me your contract, give me your address, show me your proposed renovations, give me your scope of work and a contract estimate for the work, and I can give you an answer on your loan today and make a commitment today to fund your deal. That happens all the time. That happens more often than not. It's pretty rare that a lender is going to need more than a day or two to understand your deal and to give you a commitment that you can count on to get your project funded. That is entirely different than traditional banks. So that flexibility.
And by the way, they're a great source.
What's that?
Yeah, they have a price and they're a great source. I mean, they're less expensive than your 50-50 partner that's got the money, guys. Like a lot of times when you first start off, you're thinking, oh, I got the deal. My partner's got the money. We'll split everything 50-50. Well, that's really expensive money, right?
Right.
And this is where a private lender, hard money lender plays a role. And we've always viewed them as our business partners, right?
Yep.
They're our partners in these deals.
Yep. And let's just jump back for a second, because I think Dinesh has a question. So what is 203K? The 203K program is a program of the FHA that is for borrowing money to renovate a property, right? It's for properties that need work, repair, renovation, whatever it is. You apply for the loan knowing you're going to do work. You have to show them a plan for what you want to do. You have to show them estimates from contractors for the work, and then they determine the value of the property after those repairs. They say, all right, he's going to buy it for $250,000. I see here he's got 3 estimates for $95,000 to $105,000 to renovate the property, and they say it's going to be worth $400,000 when they're done. They look at all that and determine whether or not they're going to lend you the money, inclusive of construction funding. So it actually is very similar to what we're about to talk about with private or hard money lending. It's just meant for properties that need work. So 203K is a way to borrow money with a typical government-backed loan.
Hey, Bex, can you see me fully in the frame?
Yeah, you're in there.
Okay, cool. Can you see yourself?
Yeah.
Okay, so it's just like your chin's cut off, but I can't see myself in the frame.
Oh, this is good. I'm in a submarine.
Okay.
All right.
I just want to make sure you know. Yeah, there you go, brother.
Ooh, that good.
That's good.
See my neck. Great.
Yeah. You're good.
So yeah, 203K is a construction type loan. And then the next question was, these are for short-term or transitional loans, talking about private or hard money loans, higher cost up front, but if you can flip within 6 months or refinance, it makes sense. That is correct. These are for shorter terms. Your typical private or hard money loan is going to be for 6 to 12 months on what we would consider to be a bread and butter single family fix and flip kind of project. 12 months is a long time. 6 months is probably enough, but may not be quite enough. So you'll see typically terms somewhere between 6 and 12 months. Less than 6, probably cutting it too close. Over 12, you've taken way too long if it's a typical renovation. So your terms are going to be in that 6 to 12 month period. And by the way,
we've all been there.
Yep.
We've all taken too long on projects before.
Correct. So let's talk about what happens at the end. These are not 30-year loans. So these are 6 to 12 month loans. So at the end of your 6 months, that loan is due and you either pay it back or you extend it. Most of the loans have language built into them about extending. Typically, you can get a 6-month extension from most lenders in most loans for a reasonable extension fee, right? Usually 1 or 2 points. So your $400,000 loan might cost you $4,000 to extend for another 6 months. But if you don't have the project done and you otherwise can't get a loan from somewhere else to pay them back, not a bad deal. Just inquire as to how that works when your loan is due if the property hasn't sold, and know that if it's a 6-month term and there is no other means to extend it, you're going to have to figure it out. We can talk about a second kind of how the paperwork works and what the risks and downsides are, but the term 6 to 12 months, possibly with extensions. Asking if we have tips for vetting hard money lenders for new investors. Like anything, we think the best new source of anything comes from a referral, right? So the best place to find your lender is here. The best place to find a contract or a deal in your network, right? So if you,
I'll give you some of the ones that I like. Greenbrier Lending, Rich Levine. We've got Washington Capital Partners, Danny Huertas, Leo Pareja. They run an amazing organization. There's Hard Money Bankers. Those guys, I haven't worked with them, but they've got a good reputation, in the marketplace. So there's a lot of them, right, that are out there. But those are some of the, the big ones, the ones that we've done a lot of business with in the past, right?
In full disclosure, Washington Capital Partners is a partner of ours that runs a networking group like this out of Falls Church.
Yeah, they run our Grid Falls Church.
They run the Grid Falls Church group. Great guys, great source. So, but that's how you vet them. Ask somebody who's used them and ask for referrals on how to find your lenders. So 2 or 3.
Yeah. I was just going to say, in the longer we're in this business, we know who does the right thing, right? Like businesses people that have been established for a long time, like Danny and I were talking yesterday. I mean, we've been doing business together for 15 years, right? Mm-hmm. And it's just like, same thing with Rich, right? 20 years with Rich.
Yep.
Just like, these people do the right thing and are around for a reason. And your network will just connect you with them, right? So,
yeah. No, that is why your network exists. It's why we exist. To help you fill those blanks. So someone had asked the difference between 203K and 203B. I'm not as familiar with 203B. I don't know if you are, Rob.
I'm not. I believe it is
also a different kind of renovation loan. It may be for a personally occupied.
Ruben says he can speak to that, but I don't know if we can make Ruben, I don't know if we can give him a voice in here or not.
I don't know. But Ruben, if you want, everyone's visible to the chat bar there. Just give us a
203B is 35,000.
So I don't know if that's 35,000, probably maximum renovation. So my guess is, if I had to take a quick guess, I would say 203B, yeah, max reno. So 203B is probably cheaper, slightly lower interest because you're borrowing less money. They have a cap of 35,000. So if the house needs more than $35,000 in work, you've either got to probably bring it yourself or find a different program. 203K, I know, is much higher than 35,000. If it has a cap, it's a lot higher than that. So somebody asked about the interest rate on hard money lending. So that gets to our next point here. Hard money, private money, typically costs more than your other sources. It is more expensive than a traditional loan on account of that additional flexibility. Rates now probably averaging 8 to 10, 12%. And then usually
a lot of it will
1 to 3
depend
points.
on also over time, the reputation that you've built with your private lender. The more deals you do with them, the more they want to continue doing deals with you, and those rates will start dropping down. So we see anywhere between 10 to 12%, right? It'll be 12% if you're newer, 10% if you're a little bit more established but don't have a formal, like really strong relationship, and maybe they'll start getting down to 8%, right? If
Well, let's
you're
go
just
to the
doing volume.
next slide, because we kind of start talking about how these things get priced and why.
Cool.
So the biggest difference in a private or hard money loan as opposed to a traditional kind of 30-year mortgage is it is really based solely on the deal. It's not so much about your personal ability to repay the loan like your personal mortgages. It's not really dependent on your job and how much you make a year, or even if you've necessarily done this before. It's whether or not it is a good deal, and is this deal going to pay me back as the lender? And back to Rob's point about a good lender, being a real partner in your business. A good lender will tell you if you've got a good deal. They don't want you to fail. They want to make sure that you succeed, that you make money, that it was a good experience, and you want to do it again so that you'll borrow money again and make it a longer term relationship. So in that way, a good relationship with a hard money lender is a really good check on the quality of your deal. And if your hard money lender says, hey, I don't think you can actually do this for what you think you can for renovation cost, or I don't think this is actually going to sell for what you think it's going to sell for, and here's why, here are the comps I've found, here's what's wrong with your property, here's what's causing it to not have the same value as the one that you saw across the street that you think is the same house. These are people who have done this before, usually a lot, and they know a lot about value and valuation and understanding cost and market conditions for real estate. And if they have a hesitation about your deal, it's for a reason. And I would suggest if you can't get a loan from a hard money lender, you probably ought to find something else to do to monetize that deal because they're usually wanting to do the deal. And if they're not doing the deal, there's usually a pretty good reason for it. So the flexibility and the quality of the deal and the quality of the lender is what really is going to kind of make or break your project. So if you have a really good deal and not a lot of money, you can usually get funded. If you have a really good deal and no money, you can sometimes get funded. If you're absolutely stealing a house, we've seen people get 100% financing. If it's just bungle proof and you can't screw it up, a lender may even lend you all of the money. Typically though, they'll tell you, I don't want to have all of the money. I want you as the borrower to have some amount of skin in this, either you or a partner, and they'll encourage you to find a partner with even a couple $1,000s to put in the thing. But if you don't have any money and you don't have a partner and you have no other way to get any kind of cash, but you've got a good deal, then guess what? You're now a wholesaler, right? That's what wholesaling is. You take your good deal, you sell your contract rights to somebody else for a big chunk of cash. We talk about that earlier on in the year about how to value it, but we've written 6-figure checks to wholesalers before. Wholesaling can make tons of money.
You'd be happy to pay another 6 figures to other wholesalers to bring us deals. So
absolutely
happy to do it. And by the way, Mark, I know you're going to talk about the construction, the holdback, and you're talking about how the lenders want skin in the game. But I know that there's a lot of private lenders that are dipping their toes out there, learning for the first time. Like you can borrow, like I've borrowed money before and been able to not only get all of the purchase, but all of the renovation money. And I've walked away from settlement with a check, right?
Sure.
So I want people to understand that like that's possible, right?
Right.
But when you start dealing with some of the more experienced people, they're definitely going to want to have, for you to have skin in the game. And they're going to really start looking at all the construction holdback. And I know you're going to talk about that.
This is a private agreement. So the terms of the loan are going to be whatever you can negotiate.
Whatever you negotiate. Yeah.
But if you want to know what the standard terms are for a commercially available loan from the people that we know, or from us, or if you want to borrow money from me for your project, the standard terms are, and this is actually one that should be in every private loan, that these are for commercial use only. As a lender, I can't lend you money for your personal residence. That's a mortgage, and that would mean you have to have a mortgage banking license. That is a licensed activity. So these are not mortgages. These are not loans for owner-occupied property. People can live in it. You can rent them in certain circumstances, but you cannot, as the owner, occupy a property with a typical hard money or private loan, because they are for commercial use only. You can borrow money from your family and buy a house that you're going to personally live in, but not from a stranger. Strangers, when they lend you money, has to be either for commercial use unless they're licensed to make mortgages. So first deed of trust, notes, other terms really similar to a bank loan. If you bought another property, if you bought the house that you live in, you sign those 26 pages for 10 different documents worth of loans. Same kind of thing. They'll have a deed of trust. They'll have a note that explains the terms that you're borrowing the money on, when it's due back, what the interest is, what are the conditions that would make it in default. They come with that deed of trust, which means that gets recorded against the property. That means they want to usually be in first position, meaning they don't want any other loans in front of them. If they're loaning you 75% of the value of the property, they want to be the first person in position in the land records being owed money on that property when it gets sold. Doesn't mean you can't get seconds and thirds, right? We know people that have done seconds and thirds, but usually the bulk, your biggest loan is going to want to be in first position if they're lending you, even more than a third of the cost of the house. They typically then have the same rights as any other bank would. So if you don't pay your loan back on time, they have the right of foreclosure. It's the same process. They would take you through the same foreclosure process. You go to the courthouse, goes to an auction, house gets sold, the loan gets paid back, however much is raised at the auction. You would perhaps get the difference if it sells for more. You may still owe your lender more money if it sells for less. So in that way, that's the stick. These are not then friends and family loans that you just kind of pay back when and if you can. You must pay that money back, and the lender will maintain foreclosure rights to take the house back if you have not repaid them in time. You'll typically see anywhere from 65 to 75% loan to value, just to kind of keep the math easy. So if it's $1 million house, probably the maximum loan you're going to get to buy the house and fix it up, somewhere between $650,000 and $700,000. That means if it's worth $1 million, there's going to be $300,000 potentially in profit there, right? Or there should be, or you've got to come up with the money somewhere else. The lender typically isn't going to want to lend more than 75, 80%. But we see sometimes 80, 85, right? For a strong borrower that has a history that's done it before, the lender knows they're going to get repaid. You may see higher loan to value than 70, 75%, but somewhere in that 70 to 75% range is the most common loan to value. And by the way, if you're borrowing much more than that, you're starting to get to the part of where it's not such a great deal. You shouldn't need to borrow much more than that for a good deal. And then construction holdback is, again, a loan condition where the lender does not lend you 100% of the money you need on day one, because the house that is going to be worth $1 million when you fix it up, that you're going to buy for $750 today, might not even be really worth $750 until you've put some work into it. So they do what's called a construction holdback. They say, all right, I'm going to loan you $500,000. We're going to give you $400,000 today. 100,000 of it we're going to hold until you get some work done. Do some work in the house. Let me come take a look at it. Let me send my guy to look at it, take photos, take video, however you work that out. Show me you've got some drywall up. Here, I'll give you another 30 grand. Show me you've got all of the hardwood in the house, give you another 30 grand. You come up with construction draws and you come up with milestones of progress in the house where you show that the work has been done, and you get to draw some of that additional money up to your maximum. But Rob, like you just said, you can find lenders that lend you all of the money up front. It just depends on what you
whatever you negotiate.
and
right?
really it mostly
By the way,
depends on your experience, right? Your ability to pay that money back.
your reputation.
Your reputation. So next slide, and we'll talk about a couple other things. So credit. Credit, not nearly as important to a private or hard money lender as it is to your typical bank. Most of them still will pull credit. They want to know what it is. Your credit is not unimportant, but just because you don't have great credit doesn't mean you won't get a loan. Sometimes it just doesn't matter. If you've got a screaming good deal, fine. The lender knows one way or the other. They're
protected.
And you'll get funded. Or let's say, all right, it's your first deal. You need 75%. You need the maximum amount you can possibly get. Credit's maybe not so great. How about you find somebody, a spouse, a relative, a partner, someone else just to go on the loan? I don't care if they're bringing money, but I want someone else on the loan because I want somebody with skin in this loan that does have some credit to lose. Usually people with good credit have it for a reason. They care about it. They want to maintain it. They'll make sure that you as their partner or their nephew or whoever it is going to do what you need to do to not get their credit dinged. So borrowers sometimes will find a co-borrower that's got better credit if they need them. Relatively rare. Again, it just depends on how many of these you've done before, what your track record is, how good your deal is. A really good deal, the credit is almost never an issue. Points and interest, sometimes prepaid at closing. I won't bother getting into too much of this, but just know that if your interest is going to be $10,000 over the year that you're going to have the loan, the lender may say, hey, I'm going to take like $5,000 of it up front. So your $100,000 loan is really a $95,000 loan because I'm going to keep $5,000 of the interest you're going to pay me and just not loan it to you up front. That's getting into esoteric stuff that you'd figure out when you got your first loan, kind of how that works. And then the cost we were talking about earlier, 9 to 13%, 2 to 5 points we're seeing. It all depends on what you negotiate. It mostly depends on your experience, how much you're borrowing, and all of this comes down to risk. How much risk is this loan to the lender? That's what determines the cost. If there's very little risk, you're not going to pay as much. If it's in a shady area and you're borrowing the maximum amount and you're bringing the least amount of money possible and you've never done it before and you've been foreclosed on 5 other times, you probably can still get the loan if it's a decent deal, but you're going to pay more for it because that lender knows you're a slightly higher risk. Really straightforward. The less risky you are and the less risky your deal is, the lower your loan is going to be, lower cost your loan is going to be. And that's really where the cost comes from because it is still somewhat competitive. There are several lenders out there, so you're not going to pay 35% interest on your loan like you would to the pawn shop guy because if you've got a decent deal, there'll be someone else out there that will lend you money at less than that, right?
Mark will lend it to you.
I'll lend it to you. I won't charge you 35%. If you're
such a nice guy.
Have a remotely decent deal. But the point is the risk is what determines the cost of the loan. All right, next slide. So why you would use a loan as opposed to one of these other sources gets back to leverage and your return. So again, just to kind of use some round numbers, let's say that there's a deal that you can buy that it needs $500,000, so $400,000 to buy a house, $100,000 to renovate it. You're going to be into this thing for 5, and you can sell it for 6. Let's say there's $100,000 in there. Take out the fact that you got commissions and closing costs, but just say you can make $100,000 on this loan. If you were going to borrow from a lender that $500,000, and let's say you've got $50,000, so they're really going to lend you $450,000. You're going to pay 15%, so $4,500, $7,500 or so dollars in interest and a couple of points. Point being 1% of the loan. So 1 point on a $450,000 loan is $4,500. 2 points is $9,000. let's just be aggressive and say you're new at it, and so you're paying towards the higher end, 15% and 2 points. This loan is going to cost you $13,000, $14,000, $15,000 over the course of the next 6 or 9 months to borrow, renovate this house, and pay back your lender. Great. It's going to cost you $15,000. The house sells. You've got your $100,000 spread minus 15. You make 85. Versus you borrow it from your rich uncle who says, "Yeah, I'll lend you the money. Just give me half of the whatever you make on it." Great. I found the deal. You find the money. I'll give you half. Same scenario. Sells for the 600, $100,000 profit. You're giving the uncle 50 as opposed to 15. The rate of return on your money is much higher with a traditional, properly structured loan than it is having to find a partner to split 50-50 on your deal. Because you keeping 85 is better than you keeping 50 on your deal. And leverage then makes your rate of return higher. The other way that works for leverage is if you've got $100,000 to put into deals and you need 50 for this deal, you can put 50 in this, borrow the rest. Another deal comes along, you put 50 into that. Now you've got 2 deals going, all right? You're making 2 times the money as you would if you did it entirely in cash or with less leverage. So leverage used properly is a good thing. Leverage on a deal that doesn't make money obviously hurts more. So if you put all of your own cash into that $500,000 house and it only sold for $400,000, well, I've lost $100,000. No fun. But if you borrowed money to do it, even if you lose, you're still going to owe that lender back their principal plus their interest. So it compounds your loss on a losing project. So it's not completely without downside. You want to hopefully have a good deal. But that gets back to my earlier point of a good lender that knows what they're doing is hopefully not going to let you get into a terrible deal that they know is a terrible deal, right? The guys that we know,
it's a mess. It's a mess for them to get out of as well, right? Like they don't want to be part of that. It takes a long time. They don't want to go through the foreclosure process. Then there's title issues. It ties up their money. Their investors don't like it, that their money is in this asset that didn't perform well. And so they don't want that. They want to protect you, right? And they want to protect themselves. They want to protect their investors. So, this concept of people loaning to owning, has never quite made sense to me. Right? I'm sure there's people that do that, but it can become a nightmare for the lender, right? Especially in places like the district, right?
Yep.
Or in Maryland. So, good lenders
just want to make their return, get their money back sooner rather than later. This is an attractive business to people who don't want to be invested in things for a long time, because it should only take you a few months to renovate and sell your house. So as long as you're able to do that and pay it back reasonably quickly, it should work for the investor. It works for the lender. It really can be a win-win versus the other ways that you're going to get your money. And then one of the last points about it is, even if you don't have all of the cash and you still need to raise some cash, even with the loan, in order to do your deal, finding somebody with 50 grand to go into a deal with you is a lot easier than finding someone with 500 grand to go into a deal with you, right? So you work out whatever you need to work out in the way of your partner split. You'll work out the terms of the loan, probably pretty similar to what we just talked about, but it will help you get your deals done, to have a good lender that you can call on, that will fund your deal quickly, will help you understand when you've got a good deal, will have resources if you need them for getting things done, getting other contractors in if you're having trouble with a contractor, understanding the permitting process, getting out of any one of the other half a dozen jams you might find yourself in when you renovate a deal. A good experienced lender is really like kind of a true silent partner that won't push themselves into your deal unless you ask, but will be there as a resource if you need it, and will help you make a higher structured rate of return on your deal, on your good deal, and help you understand when you've got a good deal to begin with. So that's kind of the pitch for it. And that's why
Yeah.
experienced investors still borrow, right?
Yeah, all the time. Everybody runs out of cash. You need more, you know. Now, one thing I want to kind of leave on is the importance of the real estate community in the DMV area is very small, right? Anybody who's anybody knows who the players are, and your reputation follows you in this business. It becomes a lot easier to borrow money when everybody knows that you're somebody that does the right thing, fulfills on your obligations, is, you know, somebody that's detail oriented, punctual, they do what they said they're going to do, they fulfill on their commitments, right? So this whole concept of living your word and making sure that you're always living your word and making sure that you follow through on what you said you were going to do. And if something went sideways, that you took care of it and you communicated with people and you worked through issues, like that reputation will follow you forever. And by the way, people want to lend money to you when you do the right thing, when you always show up, when you follow through on your commitments, and people will quickly learn who the people are that don't follow through, you know, on their commitments, and don't live their word. And so we live in an incredibly small little bubble here in the DMV area where you know, your reputation is going to follow you. I can't tell you the number of times where somebody's called me at a vetted investor, and you know, I'll say, yeah, no, I know them, thumbs up, great. They say they'll do what they said they're going to do. Or I've been like, you know, keep an eye open. I've heard some, you know, non-favorable things. And so you never know how that's going to come back on you. So live your word, do the right thing, I guess is my point, right?
It's like you said, it's a relatively small world that we inhabit at this end of the market. I think that might be it. What's the next slide should be questions. That's right.
Questions. I know
who's got questions about how to fund a deal? What have we not covered? What rocks are there you can look under to fund your deals? We've gotten title loans on cars. We've maxed credit cards. We've borrowed from our friends and family.
Self-directed IRA.
We've borrowed from our retirement account. And all of those are good things.
You could syndicate money, right? Or you pull money together and form an LLC. Like Mark, you put in 50, I put in 50. You know, my other people put in 50. We all own a quarter of that entity.
Yep, that is typically one of the things we talk about in September, right? When we start talking about alternative means of financing and finding deals. So we talk about wraps and syndications and seller financing and all the other kind of alternative strategies to find and fund your deals.
So here's another way to fund a deal. You can GoFundMe, right? Or you could do a equity rise and raise capital that way. Now, I've never done it, but I know other people have done it, right? And other people do it.
Sloan mentioned subject to. That is definitely another alternative investment where you take title to a property subject to its existing financing. That'll come up a little bit next month. Crowdfunding. I haven't done it either, and who knows how much longer it'll be around, but it is still a thing. There are still places like Fundrise that.
No, they're crushing it. I think they're doing well.
Yeah.
Right. There's, you know, you could go to Paris Street, right? Paris Street, by the way, if you want to become the lender, Paris Street puts up deals all the time, all across the U.S., which you have to vet, and then you can lend $5 grand, 10 grand, 20 grand, 100 grand, right? So your deal could go up on a platform like a Paris Street, right? So just know that, you know, one of the things that Mark and I always talk about is, I used to think that, you know, the old saying, he who owns the gold makes the rules, right? The golden rule. But the truth is, if you have the deal, right, that is the gold in our business. And finding the deal is not easy. So in the beginning of the year, we talk about how to find those deals, how to market for those deals, how to uncover them, how to find the deals that are not on the open market, right? How to work your network and uncover that. Stay tuned for more of that, right? We're going to be towards the end of the year. We talk more creative, talk about being the bank. We talk about subject twos, like Mark said. But as always, guys, we consider it an honor and a privilege to be able to share with you what we've done, right? Definitely next month. Mark, what's our topic for next month?
I think it is creative funding. So
Awesome.
subject twos, wraps, syndications. We try to find friends of ours who are doing some other interesting things to either join us or help us get some information on.
That would
other
be awesome.
ways.
Right? We could get Peggy, or we could get some friends that we know that do a lot of really cool creative stuff, right?
Yep.
And by the way, guys, if this has been helpful, if you found value, do me a favor, give it a like, share it, right? Give it a shout out. The larger our network is, the better it is for everybody. I can't wait till we all go back in a physical environment so we can break bread and grab a cup of coffee, because so many deals get done. But let me tell you, like, I did a video, right? And I talked about me wanting to buy a piece of property, in the country. And I had multiple people send me deals. And one of them I'm ratifying tonight, right?
Yep.
And so the power is in the network that you create all around you. And this is part of that network. And we appreciate you guys being part of it.
Let this group be your megaphone. Put your message out on a big enough megaphone, and opportunity will come to you.
Comes to you, right?
The bigger it gets, the more we'll all do.
Okay. Well, I'm off to go watch my daughter roller skate.
You do that.
So.
Pads on. Thank you, everybody, for coming out. Look for us to announce next month's meeting. Be the first Tuesday of the next month. Probably here online again, like Rob said, till we're back in the room, which hopefully will be also coming soon. But look for more from us here soon.
By the way, if you guys have questions, you could always probably DM me. Just find me, Rob Chevez, on Instagram or Facebook. Feel free to ask me a question. Happy to grab a virtual cup of coffee and chat with you a little bit about anything that you want to know real estate related. I love to talk about this stuff with my buddy Mark, and we're happy to do deals with you guys. So make it a great day.
Absolutely.
Take care.
Yep. And somebody had a question there. I'll put your email there, Rob. So rob@thecazagroup.com. Follow up with you there.
Sure. Okay.
Cool.
See you guys.
Thanks, guys.
Thanks, LA, for helping on the back end.
My pleasure.